To understand the physical reality of the artificial intelligence boom, you have to look at the massive data centers currently being built. These facilities stretch to the horizon and cost billions to construct, requiring a scale of capital the tech industry has rarely seen before. Inside these shells, the financial math is brutal. Roughly 70 cents of every dollar spent on an NVIDIA H200 GPU flows directly into NVIDIA's profit margin. This 70% NVIDIA tax breaks the fundamental business model for cloud providers like AWS and Azure. When the core supplier captures the vast majority of the margin, the hyperscalers are effectively boxed out of their own long-term profitability. The problem is compounded by supply. Throughout 2024 and 2025, NVIDIA rationed its best chips, leaving the most valuable companies on Earth waiting in line on a single vendor's allocation list, unable to secure the hardware they needed at scale. Relying on a single dominant vendor transforms cloud infrastructure from a profit-generating asset into a multi-billion-dollar wealth transfer. To escape that supplier trap, Google, Amazon, and Microsoft committed a combined $270 billion in capital expenditure in 2025 alone. They began aggressively building out alternative data centers anchored by their own custom hardware. Wall Street reacted negatively to the spending, focusing on the temporary erosion of free cash flow. Amazon, for example, dropped from a positive $3.6 billion to a negative $12.4 billion in a single quarter as they funded new massive server farms in Indiana and North Carolina. Because of this heavy spending on AI infrastructure, tech giants that usually lead the market stumbled. Over the course of 2025, Amazon and Meta actually lagged behind the broader S&P 500's 17% gain. This $270 billion was a mandatory, upfront fixed cost designed to permanently delete a crippling variable cost from their balance sheets. That escape route is built out of custom in-house silicon. Google's TPU, Amazon's Trainium, and Microsoft's Maya represent the primary weapons in this hardware counteroffensive. These hyperscalers are intentionally sacrificing raw peak performance to design chips that run specific workloads at a 30 to 40% lower cost. To see this trade-off, separate AI tasks into two categories. Training is complex and flexible, but inference, answering billions of daily prompts, is repetitive and high volume. Because inference drives long-term costs, hyperscalers are ruthlessly optimizing custom chips for these specific tasks to lower daily expenses. Dominating the AI infrastructure market depends on owning the cost curve for high-volume tasks rather than chasing raw performance peaks. Google holds a decade-long head start in this strategy. They began shipping tensor processing units in 2015, and by 2026, they can train and serve their Gemini models entirely end-to-end without needing NVIDIA at all. Amazon essentially bought its way into relevance by committing $8 billion to Anthropic. That deal creates a massive captive workload that forces Amazon's Trainium hardware to scale at a speed few others can match. Microsoft is the newest entrant, deploying its Maya 100 chips to offset the staggering inference costs generated by OpenAI and millions of corporate Copilot users. The landscape shifted again in April 2026. Microsoft and OpenAI restructured their partnership, removing Azure's exclusive rights to host OpenAI models and turning cheap, multi-cloud inference into an open battleground. Designing and manufacturing a chip takes years and costs billions. These custom programs only make financial sense if the company has an enormous, captive customer workload already waiting to use them. Moving into the first quarter of 2026, the financial logic behind this massive hardware pivot finally showed up in corporate earnings reports. This chart shows a massive surge in earnings. The Magnificent Seven technology companies posted a blended earnings growth rate of 61%, compared to just 16.4% for the rest of the market. This data reveals that the companies that lagged in 2025 due to their heavy infrastructure spending, specifically Meta, Alphabet, and Amazon, are now the primary drivers of this outsized earnings growth. The long-term cash flow benefits of operating outside the 70. NVIDIA retains its dominance in frontier R&D, while custom silicon slowly takes over the massive, repetitive task of enterprise inference. This in-house escape hatch permanently caps NVIDIA's long-term pricing power and secures the hyperscaler's structural profitability. In a maturing technology cycle, infrastructure independence is the ultimate corporate moat. In the AI era, Renting hardware makes you a customer, but owning the hardware makes you a kingmaker.